North America poised for bold interest rate moves. Will the rest of the G7 follow suit? Imagine a scenario where the economic pulse of North America is about to quicken with decisive actions on interest rates, leaving the other major players in the group of 7, G7, nations in a state of watchful anticipation. This isn't just routine policy. It's a potential game-changer for global finance that begs the question, are we on the brink of a new era of monetary policy divergence? Welcome to Eco Week Ahead, your go-to source for insightful economic commentary. As we dive into the week of October 25, 2025, at 8 p.m. Universal Time Coordinated, the spotlight shines brightly on policymakers in Washington, D.C. and Ottawa. These key figures are gearing up for what could be pivotal moments, with anticipated interest rate reductions in the United States and Canada taking center stage, while the remainder of the G7, comprising countries like Japan, Germany, France, Italy, and the United Kingdom, appears content to maintain the status quo for now. Picture this. North America is stepping into the role of the primary arena for monetary maneuvers on a global scale. A series of 4 major central bank announcements is set to unfold rapidly, spanning just over 24 hours, and kicking off on Wednesday with what experts widely predict to be quarter-point cuts from both the U.S. Federal Reserve, often called the Fed, and the Bank of Canada. To clarify for those new to this, the Fed is the central bank of the United States, responsible for managing the nation's money supply and interest rates to promote economic stability. Think of it as the conductor of a massive financial orchestra. Similarly, the Bank of Canada performs a parallel function for Canada's economy. These quarter-point reductions would mean lowering the key interest rate by 0.25 percentage points, a move designed to make borrowing cheaper, stimulate spending, and potentially boost economic growth. For beginners, this is akin to a homeowner seeing their mortgage rates dip slightly, encouraging them to invest in home improvements or spend more freely, which can ripple through the entire economy. But here's where it gets controversial. Could these North American cuts create an imbalance, favoring regional prosperity at the expense of global harmony? Some economists argue that if the rest of the G7 holds steady, it might lead to currency fluctuations or even trade tensions. Imagine the US dollar weakening relative to the euro or yen, making American goods cheaper abroad but complicating imports. On the flip side, others see this as a savvy strategy to address unique challenges in North America, like lingering inflation or labor market disparities, without dragging down partners who might not be ready for similar moves. And this is the part most people miss. The timing of these decisions, compressed into a tight window, highlights the interconnectedness of modern economies. While the Fed and Bank of Canada lead the charge, the world will be watching closely to see if this sparks a domino effect elsewhere in the G7. For instance, if these cuts prove successful in cooling down inflationary pressures without stalling growth, it could pressure other central banks to reconsider their positions, potentially leading to a more synchronized global response. What do you think? Do you believe North America's proactive stance could inspire the G7 to break from their hold? Or is this a recipe for economic divergence that might widen wealth gaps? Share your thoughts in the comments. Let's discuss. Should central banks prioritize national needs over global coordination, or is unity the key to sustainable prosperity? Your input could shape the conversation on the future of international finance.